Hey everybody, Boris. Welcome to the weekly technicals for the commodity dollars, Aussie dollar, dollar CAD, and Kiwi dollar for April 24th to April 28th, 2017. And really not much of a change in the COM dollar land. It is the low volatility trade, with the exception probably of dollar CAD, which has seen a lot more expansion of volatility, especially since oil now is flirting with a sub 50 level. But as far as Aussie and Kiwi go, it's very quiet, not much going on in the COM dollar land, and they're sort of going to be, I think, in some ways, of course, the quieter, more restrained trade in the market, especially with all the focus on the euro and cable and yen and the dollar this week. Let's take a look at how the calendar shapes up. Again, a CPI data out of Australia, not really much of an expected change here. Perhaps if there's a small trick up to 105.06, that could provide a small bit in the Aussie. Aussie really has just kind of pretty much not really traded in any direction, holding that 75 bid. RBA is stationary. There is mixed environment in the Australian economy, with retail sales weaker, but employment's holding steady. So it's steady as she goes. There's really no major movements. All of the movements, I think, in many ways in commodity dollars these days are really a function of the dollar rates. If U.S. rates continue to decline further, the carry trade makes those the Aussie and the Kiwi trades more attractive. If we're sort of stabilized at these levels, I don't see much volatility coming up either way. The one exception to the commodity dollar land is going to be the CADI. The Loonie has seen much greater volatility because oil now is above below $50 a barrel, and that certainly pushed dollar CAD to the 135 level. But having said this, it's been far more resilient because, ironically enough, Canada is far less now oil dependent than it was before as far as the economic growth goes, and that'll be very obvious when we look at the retail sales this week and the GDP. If both of those numbers beat to the upside, you're going to see a much greater disconnect between the price of oil and the Canadian dollar, and it'll probably come back down below the 135 level. It's still, I think, pretty much a sell the range trade as far as that goes. Let's take a look at the levels first, and then we'll go to look at the charts. The levels pretty much remain the same, although Aussie now really sees resistance at 76 instead of 77. Dollar CAD is the big expansion range, about 300 points here between the support and resistance, and Kiwi still staying with a modest bid to the upside at 71 looks to be the big resistance point. So if you look at Aussie over here, definitely the 75 holds 1, 2, 3 times, looks modestly bullish, but if you look at it from a longer point of view, it's really sort of a neutral resolution. The reason why I say this, why it doesn't look as bullish as it may appear at first, is because in addition to having a base, you have a series of lower highs. And effectively, you have a situation now here we call a volatility squeeze, where the highs and lows get smaller and smaller and smaller, and the break, one way or the other, determines the longer term direction. So 75 holding, but very vulnerable. If that comes back under stress, a break of the 75 really opens up a move all the way back down towards the 72s. A break of the 76 to the upside, however, does look much more positive for the Aussie and opens up the whole run back up for a challenge towards the 77, 77.50 level. So probably a buy to dip here in the near term, with a very, very tight stop at around below 75 is the least, I guess, is the most consensus view trade in the Aussie. Now dollar CAD, much more interesting trade here because it is definitely reaching sort of the upper end of this range, and I think the contrarian trade here is to sell the range. In other words, believe that the 36 is going to hold, that the top of the range is going to hold, and CAD is going to come back down. This is going to be a bet basically on better than expected Canadian data, on the fact that oil stabilizes underneath the 50 level, which is very likely to do. And the U.S. numbers are really not going to be that great, so it means there'll be no rate hike in June. If you sort of assume that broad scenario, you have a very reasonable chance of getting a very good beachhead above the 135 level, certainly against this 136, 36.50 stop. If we get above 36, the whole range strategy really falls apart. But between 35 and 36, trading the top of the range, fading it, that is selling against in the belief that the top will hold, probably a very decent trade with potentially a move back down to 134, 33 on the over the long period of time. Now Kiwi, on the other hand, actually looks better than Aussie when you look at it individually. Held up at a higher low at the 69s, holding the 70s. We had better than expected CPI last week, but it was very, very deceptive because it was all driven by one-time increases in tobacco costs or tobacco taxes. So basically, I don't think RBNZ is really going to be looking at this as a hawkish number, but it's certainly not dovish, and therefore, and the dairy auction results have been positive. All of it really sets up a pretty decent trade to the upside, and certainly a pretty decent relative strength trade. We'll be looking at the crosses and the Aussie Kiwi because I think there's a potential there for a trade as well. I like Kiwi as a relative strength trade here, especially against the Aussie, because it looks both well technically and relatively decent fundamentally. Wish you guys the best of luck, the best of trading. Boris, over and out.